is Nanne Dekking. I'm the chairman of the board of TEFAF. We're all delighted with what happened yesterday. I don't know if you were here. Let me say one thing though. We love to have great press, but sometimes it looks as if it's almost a surprise. The only thing I want to say, TEFAF has been doing this for 33 years, and we hope that we brought a certain quality of art fairs to New York. We're delighted to be in New York. It's a great match, of course. So, an old brand coming to New York, trying to rejuvenate a little bit. That's actually the part where I come in, not because of my age, because I'm 58, but some may know that in my day-to-day business I'm an advocate for change in the art world. I actually believe that it's indeed good news when people my age and my color buy art, but people my age will in 10, 20 years most likely not buy art, and when they buy art they will be having a walker. So for me, expanding the marketplace is the most important thing. Only in the art world, I've been in the art world for many years. I'm definitely not a dealer anymore, otherwise I couldn't be the chairman of this board. But having been a dealer, I realized we never look at new clientele. We only look at the people already buying art. So that's one of the reasons why we, as an umbrella organization of TEFAF and the board of TEFAF, we want to tell the dealer community, you know, in a way that the tanks that are lining up on the lawn, all these kind of new companies try to create what they call transparency, all the new regulation coming our way from governments. It's our task to make sure that the dealer community at least understands how fast the world is changing around the art market. That's also the reason why we have someone like Anders Petterson here, to give him a very specific task in a kind of report we wanted to present to the art community. As you know, lots of people are actually spending money on art, but a lot of people at the higher echelon of the market, they have wealth managers, they have to deal with their banks, and these new people who have to look at the data of the art market don't necessarily trust the data that they see. And sometimes they're actually right. So we believe that art as an asset class has to be taken seriously. And as you know, we at TEFAF were the first fair to start with very stringent vetting procedures. Actually, we feel that our vetting procedures should even be more stringent. It's now the highest quality of vetting possible, and that gives people confidence to buy. I mean, the New York Times yesterday said it's because of the vetting procedures, so much was sold yesterday. By the way, I'm looking at Diana. She told me if you need tickets for the fair, we have them here, and I don't want to forget that because I think you want to see the fair afterwards. So, but back to what we try to do as an umbrella organization and what TEFAF stands for. TEFAF stands for credibility. That's what we want to achieve. You know, if you look at the global art market, it's worth currently $56 billion. And when I was a dealer, I always thought, whoa, we're such a big market. I can tell you that a company like Dell has more revenue annually than $56 billion. So that's something to put it in perspective. So expanding the client base is key, and that's what we really try to do. And it may sound almost unimaginable if you see what kind of people were buying yesterday. We have confidence in these people. We're happy that they're buying, but we also realize there will be a new generation of buyers, and that's what we're looking at. So what Anders did was actually write an incredible report, very detailed, very granular, in how art is looked at from a different perspective, actually from a financial perspective. So, thank you so much for doing that. Anders will talk now, but I also want to tell you it's actually Tim Schneider, who's sitting there on the right. You may all know his writings in the art as an art business reporter for ArtNet. I actually really admire his writings, which is always the wrong thing to say when you're surrounded by journalists, but I think he's a great writer because he always takes an outsider's angle to the art world. And he's also the founder of the Grey Market, and I love the terminology, Grey Market. Without further ado, Anders, thank you so much for everything you've done for TEFAF.
Thank you, Nano. I'll just put this one here. That's correct. Okay, we got, I think, about 20 minutes, and then I will join that empty chair there for a discussion. So most of the focus, I think, will be, well, I think looking forward to kind of discuss some of the findings. What I will try to do over the next 15, 20 minutes is to kind of just outline what's in the report, which is now live. But first of all, I want to just thank TEFAF for commissioning us to do this report. So this is on the back of 7-8 years of work in this art and finance field. So this is the intersection between when art meets finance, and the tension and friction and opportunities that these two markets present to each other. This allowed us to delve into a very specific part of the art finance market and really looking at the dealer community and how they finance themselves, etc., and also looking at from a provider's point of view and speaking to industry experts like Evan, like Stephen and others, has really helped, I think, the report to kind of get a sort of certain gravity. It's not there as a be-all, end-all. I think it's a starting point for a discussion. I think there's a lot of things that needs to be addressed and solved. Hopefully, again, all these research reports that we are involved in is really to try to kick off this debate about what is the role of finance in the art world. I would like to particularly thank Diana Cordell from the TEFAF team for supporting us, and Michael Plummer throughout this process. You get the dealers involved. We had 142 dealers participating in the survey, which I think is a great response rate for maybe a community I thought might be reluctant to actually be involved in this. I think it showed otherwise, and I think that has given the research also an endorsement from the community that it's actually supposed to serve. Obviously, the TEFAF community is a very specific community, but I think from the purpose of looking at dealer financing, they're relevant. Hopefully Tim will discuss what happens to all those other galleries that might not fit into that segment. Do they have access to finance and so forth? I think that's a bigger issue that we hopefully will discuss. Right, so basically what I will try to intend to do is looking a little bit at the research objectives behind this, just some of the broader finance trends that we have seen and how this fits into this context, and then some of the key survey findings. We look at some challenges and then some of the future topics that hopefully we can then start to discuss in the panel itself. I think I need to be in reach. So in terms of research objectives, was really, first of all, was to try to understand how dealers currently finance their business and their business activities. From the sort of day-to-day inventory, what sources are currently being used, what is available to them, and it was really to try to figure out, what role does debt financing play in the business itself. How do dealers often, how do they deal with unpredictable sales patterns? How do they combine that with the purpose or having debt in its structure? And also then the second thing was the type of finance is currently available to art dealers. This is really looking from the provider's point of view and looking at what is accessible to them, from the private banking type of financing that Evan is in charge of, down to the asset-based lenders like Athena, which is sitting here in the room, and others. And it's really, again, to figure out, where's the friction, what is working, what is it that makes it difficult for galleries to obtain finance? Is it a perception? Is it sitting on the demand side in the sense that is it about the galleries or is it about the providers? And I think in a sense it's probably a bit of both. Finally, it was really trying to sort of identify some of the key challenges, and hopefully this will be a springboard for others to sort of catch on and say, let's try to do something with it. And hopefully we'll, again, elaborate on some of this in the discussion itself. Right, just to kind of give you a bit of background, obviously, Nana talked about art as an asset class. We have already an incredibly week this week with a number of art fairs opening up. TEFAF yesterday, the reports that I read was incredible sales. We have an amazing week next week with Christie's Rockefeller sale, and this is all set to be kind of a record first half of all times. So we're dealing suddenly with 7-8 figure sums, artworks being sold for almost close to $500 million. Around this is a whole ecosystem of service is being built. Financial services, financial guarantees, lending products, which we're going to talk about today. And this sort of move of art towards an asset class, I think it's kind of irreversible. To the point where actually the governments, obviously, regulators are taking an interest. In the EU, new legislation regarding anti-money laundering was introduced 2 weeks ago. There was an article in New York regarding the same thing happening, lawmakers here in the US. Don't know if I will to what degree, but these things are happening. So it's obviously this thing of, courting the art world and the finance world. It also presents certain challenges, which is not, you can't just simply tap into the finance world and think that's going to just happening in the same way as you've been maybe running your traditional business. It's a lot now in terms of professionalization and complying to the rules of that finance industry. So part of this is something we want to look at later on. Now, so where does this lend? How does this art lending, art secured lending, how big is it? A year ago, or in Deloitte published a figure which we've also involved in the same report of 17 to 20 billion of art secured loans out there. The majority of this sits in Evan's world, which is private banking. These are not asset-based loans. These are loans against the wider wealth of a client. But it's still art in it. It's an art part of a bigger collateral, a bigger pool of artwork. Now, the purpose of the report this year was kind of saying, okay, so how much of this is going to dealers? How much is benefiting? How much of these finance worlds actually benefiting the dealers themselves? Because ultimately, we wanted to try to understand what is the use of finance, and particularly debt financing in the dealer market or gallery market. Now, we estimated, again, based on interviews and based on feedback from the providers themselves, that this market is somewhere between 1.4 billion and 2.1 billion. About 8 or 10% of the market as a whole. Relatively small part. If you looked at this as a part of the dealer sales, I mean, basically last year, 2017, according to the Art Basel report, it was 33.7 billion. If you use the gross value of that, we would say basically this is about 5 to 8% of is debt financed. Now this is compared to any other industry, it's low. It's very low. I mean, we're talking about normally retail industry, something between 40 and 70% of the business is financed by debt. Look at the car dealerships. Look at how things, So the question is, why is it so slow? Why it's so low? Maybe it's a good thing. I'm not making a judgment and saying it should be really, really big, because maybe this is what makes this art world so sustainable. Maybe the fact that there is no leverage, so no debt. When we have the crisis of 2009 or other, liquidity events, maybe it's because there is no finance, no debt involved in the structure, which actually makes these galleries survive. Or maybe it's because there is actually no access. So this leads us to the survey itself. 142 dealers, majority being in Europe, and that's the demographics of the TEFAF, and this is the history of TEFAF. It's worth bearing this in mind because the European art-secured lending market is tiny compared to US. So you have somewhere between 90% and above being here in the US and the rest being in Europe. Part of that is the UCC, Uniform Commercial Code, which is a legal structure that makes it easier for the borrower and the lender to operate in terms of they can, mostly it's just for a simple thing of keeping their works in their home. In Europe, we have a problem in the sense that there's the Europe, there's 28 member states. Each one has a slightly different legal framework. You're trying to shift one work from one jurisdiction to the other. It creates a lot of problems. So this has basically meant that the maturity of the industry and the development industry has been very different between US and Europe, and the majority of the business is taking place here. In the UK right now, there is a bill going through the parliament of creating a very similar structure to the UCC, which is a mortgage of goods. This is a very similar, trying to make it easier. It might strengthen the UK art lending market, but again, we have this problem, and Evan touched upon this in his contribution to the report about this harmonization of legal structures between bigger art markets. And one of these things is, it is a real issue that we partly because of the way the artworks are now globally moving across the world. In terms of sales, the sample is largely dealers above, 47% was above 5 million in annual sales. 15 of these had over 20 million. These are big, large dealers that we also will see later on in terms of the findings, that there is a certain bias and then there's clearly much more access to finance for the bigger dealers than there are for the smaller ones. And the question with that, is this further polarizing the art market? Is the fact that there's more access to finance among the big guys, that does it make it this difference between the top-tier galleries and the mid-tier galleries even more pronounced? In terms of collecting category, contemporary art and impressionist and modern are the biggest part of the sample. Again, this corresponds, I think, with also the most liquid part of the markets. This is where most of the lending will take place. So hopefully, when you see the findings, bear in mind that this might be more on the conservative side. I think if it was only a US sample, you might find a slightly higher adoption of financing. And where I have illustrated as much as possible the difference between US and Europe. So this is just a distribution. So where on this axis we basically have how much debt you have. So percentage, so debt to asset ratio, how much debt do you have as a percentage of your total assets. And you can see the majority sits in this 0 to 9%. 64% said they had less than 10% leverage. Actually, 56% of these galleries had no leverage at all. That's more than half. There's no debt, no finance. And that's obviously, if galleries can manage in that way, no finance, no need for external, you just run your business, that's not a bad necessarily. I mean, people might argue that that's not an optimal capital structure. You should have debt in order to grow faster and so forth. But maybe this is actually what has made the art market resilient, robust, particularly in light of what's happened in the world. So I'm, again, not trying to force, and I guess this is a debate maybe we can have later on, what should galleries really use debt? Or maybe should they just rely on building up a sustainable business based on their retained earnings? So the difference, when we looked at the use, there's clearly larger dealers, more access. There's more debt among dealers that operates in modern contemporary impressionist art. Again, dealing with that the lenders typically would probably be more reluctant to lend against categories where there's smaller, more in frequency. So they're focusing on the big categories that you will see next week. Is going to account for, I don't know what the estimates are, but potentially several billions. There is a high debt-to-asset ratio in the US, which is, I think, reflects the facts of the maturity of the market here in the US versus Europe. And then finally, what we're starting to see is that, generally, people who's already starting to use art-secured finance, who has had some involvement in it, are generally high leveraged. And I'm going to look at something later on which just illustrate where is that money coming from, because that's in itself quite interesting. Okay, so the question we asked was, have you ever obtained credit loans secured against art exclusively or as part of a portfolio? 15% of the total sample said yes, which is a modest sum. 83% said no. We can see already here the difference between US and Europe. Twice as many in US of the US gallery, or twice as many of the US galleries has actually adopted art-secured finance or used art-secured finance. And you can clearly see also that the larger they are, the more access they have. So where's it coming from? I mean, this is interesting because large portion is coming from the private banking side, which is reflecting also the way that the market is structured. Now, Evan probably will, if you asked him, who has access to that, that's not going to be every single dealer in the world. That will probably make the market only accessible really to the very high, ultra-high net worth individuals that can combine their personal wealth, potentially combine that with their business and the gallery. So when we look at the size of the gallery, the bigger the galleries are, the more choice they have, and the more access they have to different like companies in general. The problem is that as you're starting to move down the tiers of galleries, these options starts to disappear. And I think this is, again, as I mentioned earlier, the contribution of lack of financing for smaller galleries are contributing potentially to also this constant thing of the gap between the mid-tier and the larger tier galleries, which I think is something that, as an industry, we need to start to address. You know, simply giving finance to the bigger ones is just going to make them even bigger. And I think that somehow we need to find a way of leveling this ground. How do they finance the business? Okay, we talked about already. Retained profits, co-investment with others. So either using just the money you make on sales and savings and put it towards growing your business. The second thing is co-investment. And I think the co-investment side is interesting because on one hand you can say, well, that actually might be a very expensive way of financing things, because if you have to give up half of your profit to someone who's coming in on the deal, that might, you know, you could have gone to an asset-based lender and maybe borrowed something at 12 to 14%. But on the other hand, the co-investment side is also, when I talk to more, particularly in the old master segment, there seems to be a way for the dealers to share risks. And then when they have bought something, it's obviously also then to have an ability to have a distribution channel, not relying on only one dealer selling the work, potentially 4 or 5 of the dealers selling the works. So these two are clearly other ways that the gallery sector is accessing financing without actually relying on the debt market. The question is, to what extent can we grow this? Should it be grown? What can the dealer industry do to make it more acceptable as a risk to the finance industry? And what need the financial providers? What do they need to do in order to try to maybe understand the gallery and dealer business better? So this is just quickly looking at where to retain, what are they using it for? Retained earnings is virtually used for every part of the business, from the financing inventory to finance art fairs and exhibitions, to looking at new business opportunities, financing working capital and so forth. And from the private investors, it's really they coming in on specific business opportunities and specific investment opportunities. Part of it is also financing inventory. Right. So does that mean that there's no demand for financing? I mean, they seem to be doing okay. Well, a third of the dealers said, we want finance, we need finance. Another third, or 28%, said that the lack of access to finance has hampered growth. It basically means, again, that those who has access grows faster than the other ones are now lagging behind. So I think this, again, it raises the issue. The fact that it's not used doesn't mean that it's just the way that this industry is. I think there is definitely a need, and I think in most industries you will see the same. It's just that there are aspects of this industry that needs to be tackled and needs to be discussed, and hopefully something we can talk about in the panel later on. As I said, the purpose of this report is probably just put forward, saying, well, this is happening. We need to act. We need to do something. What can we do? So the challenges, when we look at from the dealer's point of view, they say, well, this is just much more trouble than it's worth. This is almost a kind of a catch-all a little bit, because there's a lot of things in that. What's all this trouble about? Well, the trouble is in many ways. It's trouble about the process. It takes too long. It's too expensive. It's trouble about how the finance industry thinks about value, because value is, for a dealer, might be a very different perception of a value for a lender. And this comes back to the retail value versus auction value. And if you take half of the auction value, which is the loan to value that provides then suddenly you have this mismatch between just purely how people think about value. And I think this is an issue. So part of this is I think it's education. I think it's about raising awareness about what and when is debt and financing appropriate for a gallery, and when is it not? And I think that's a fair discussion to have. I think the dealer industry also needs to realize that the finance providers is not going to just sort of hand out millions without doing proper due diligence. I mean, you don't do that when you get a mortgage these days. You just don't simply, it takes time. You're not going to get the mortgage the day after. You will have to go through a number of things, submit the bank statements and all these things. And that's the same thing. It's just that the art world is still a little bit stuck in this thing of secrecy, non-transparency, which doesn't flush very well with the other side. That I see the tie in the corner of my eye, and it's it's a very impressive. No worries. So what is it that we need to be cautious about? There's a market thing as well, which I think we should be aware of, and that's just how the dealers are generally. There's a market that's unpredictable sales patterns. So talking to people saying, how would you describe your sales? Well, I have 3 times a year where I sell, the rest I don't. Now, for a bank to look at this, and you're looking at the balance sheet, and you say, well, each month, no income, and suddenly it peaks, and then no income, that's sometimes hard to grasp. And from the underwriter process, I don't know if Evan has in his world, but if you were starting from a bank perspective to look at this, why would I take on this risk without actually, how do I, partly not understanding how the gallery business works? And I think this is a bit of the issue, and I can see some of the smaller lenders are spending a considerable time in trying to understand the individuals behind the businesses, and it's become a much more a bespoke relationship. Volatile art prices and sort of major liquidity events are what often are the fare of the dealers. Now, these are no different from any other market, but it's the perception. The dealers are afraid of having debt in the structure. Some of them are going back to the 1990s and said, we remember the 1990s, and it was not a pleasant time, so we're never going to be there again. So there's also kind of a history here of what happens when debt becomes a common way of financing. And I think, there's obviously things coming out in the media now and then of things going wrong, but so does it do in other industries as well. So finally, in terms of the key challenges we have, from the provider's point of view, we have regulation, increasing regulation, slowing down the underwriting process. There's issues around valuation and due diligence, things of establishing clear title, authenticity. All these things are tricky, difficult. It's not that you have people who can't do it, but it's an industry where many of these things are often not streamlined and can take time. Title and authenticity, as we talked about, professionality and transparency. And the final bit there, I think it's a key issue. It's to start to be receptive to change. That as an industry, if we want to move forward, no one wants to change. I mean, I'm quite happy the way things are working, but sometimes you've got to step up, and I think the industry as a whole needs to start to do that in order to move to the next stage. So the future, what is it? Some areas, hopefully, that we can discuss in the panel. I think education and maybe this research piece is a start of informing people about what's currently happening. I think the contributions that has been made from the external providers are a great perspective of how different people view the marketplace. I think the more knowledge we can bring to the market, valuation, it's a tricky theme to establish neutral valuation. How do you kind of almost kind of detach this thing about value and the people valuing? And that's come up again and again in many of these cases. Particularly, I don't know if this is not a European thing, but among the European lenders was the reluctance of dealers to have certain values looking at their work because of the privacy of their collection. They didn't want to have anyone looking into it. So all these things are kind of makes it tricky, because if you can't value, then obviously it's hard to establish the amount you want to lend. Data and risk management. I think bit by bit we will see more and more about data being used to measure risk, price risk correctly. Technology. Nana mentioned archery, and other people now working with the blockchain and what that can actually do to start to potentially create an infrastructure where we can look at things, for example, like title registry. And then finally, the legal framework, the harmonization that we might need to start to think about, and maybe different lawmakers across different regions and different parts of the world to start to coordinate these efforts. So these are all frictions that are solvable, or at least addressable. But it requires a coordinated effort from many of us who operate in this field. So with this, hopefully I'll just jump into this seat. I would like to say thank you for your attention, and we'll move in. Thank you.
Thanks, Anders, and thanks to everyone here for showing up today. Thanks to the Cosmopolitan Club for hosting us, and for letting me in the door, which is not usually what happens when I try to walk into a place with crystal chandeliers, so I'm going to enjoy this. Let me introduce our panelists. I'll go from your left to my right. So obviously first we have Anders, who is the founder and managing director of ArtTactic. Next up, Evan Beard, who is National Art Services Executive at U.S. Trust Bank of America. And then Stephen Brody, who is partner in Blank Rome in New York, specializing in art law and in commercial and real estate finance. So, and I should mention that both Evan and Stephen are some of the experts who contributed independent essays to the report itself. So you can find more from them inside the actual document. Now, Anders, obviously you gave us a great overview, I think, of a lot of the high points here, and the majority of the report does deal with dealers and their financing, but there's one thing that I wanted to highlight really quickly, which speaks to the first point that you brought up, which is this huge disparity between the amount of the market, the art lending market, that's going to collectors versus to dealers. And just to run that back really quickly, out of a market that's estimated to be $17 to $20 billion in size, we've only got about 8 to 10% of that that's going to dealers. And the rest, which is somewhere between $18 and $19 billion based on that estimate, is all going to collectors. So, what is it that collectors see in their artwork or have in their artwork that dealers don't, that's allowing them to suck up all of that capital? And then what are they using it for?
I could jump on this. I think it's less the demand from the dealers and it's more the comfort level of the lender. So most of our book, probably 98% of our art loans are to collectors. And it's not because their art's any better than dealer inventory or dealer collections. It's because they have independent wealth and we underwrite them. And so we look, do they have a balance sheet? Do they have independent cash flow? And that allows us to get comfortable lending against their art. Dealers, they're in the art business, so the loan against the art is going to be correlated with how their business does. So it becomes something called art dependent. That's been a real challenge for us, so what we've done to get around it is many dealers who have private collections, we lever those private collections as a working capital line so they can run their business. This still gets back to the smaller dealers, the smaller galleries don't have access, at least through us, to this. The big ones do. What are they using it for? Everything from, we had an art loan last year for a collector who was building enough hotel rooms in a city that will enable that city to host a Super Bowl. So you're going to see a kickoff in a few years in a city that's going to be enabled to host that city because of an art collection sitting in that city that's providing that capital. This year we did a very interesting deal for a sports owner who was going after a prize player. And so he levered his art collection to pay a signing bonus on a player who's now in the NBA playoffs right now, which is kind of interesting. So they're still live. So you may see in the NBA Finals this year a superstar player who's enabled to get paid because there's a few Picassos sitting in a warehouse somewhere. So there's lots of different ways. And we've become comfortable at this. The last thing I'll say is this idea of doing third-party guarantees has been a real trend. Many of our collectors have decided to segment their art from their overall financial life. We put a credit facility against their art, and they're playing this third-party guarantee game at auction. So the auction house will go out, they'll get the consignment, we'll put a credit facility, and they'll put third-party guarantees against a few works they want to own. So they either get to own it at a discount because the auction house pays them a premium to take the risk off their books, or they get upside overage. We all saw the Da Vinci last year. Who was the big winner that night? Was it the consignor? Was it the auction house? It was the guarantor. The third-party guarantor walked away with $30 million that night. They didn't buy anything, they didn't sell anything, but they're playing this game, and that was backed by an art loan. So dry powder enabling them to make a quick $30 million in one night. So, it's kind of an interesting new financialized game, but we're more comfortable with the collectors at this point for a number of reasons we'll probably get into.
Stephen, you obviously have a somewhat different background, and you're coming at this from commercial real estate. Is this space, the types of things that Evan was just talking about, how much of that is unique to art lending, and how much of it is the type of thing that you would see in loans secured by other assets?
It's actually, the risks in lending against art as collateral that's what's actually unique. You don't have, for high value assets, you don't find risks as to title or as to authenticity or attribution. These are things that are unheard of with other high value assets. So from the lender's point of view, you start out with that as a problem. Now there's ways of mitigating those concerns, but many of the kinds of things that I think would encourage more lending to dealers as if they were another kind of a middle market business, which is the size that most of them are in, have to do with business practices that need to mature. Now, I've been a lawyer for a long time in New York, and I have watched I used to do a great deal of work in the core middle market commercial bank sector. I still do a fair amount there, but I used to do exclusively that. And I've watched the business practices, the quality of the accountants, the quality of the moving from compiled statements to audited statements, having real chief financial officers in some of these businesses that are not enormous businesses. All of that has grown as a practice, a regular course of doing business among middle market businesses, borrowing from commercial banks in New York over the last 20 or 30 years. That's the kind of thing has not sufficiently penetrated the art business, in my opinion. And I think it could, but it would require some recognition that those things are even more important in an environment where the collateral has these unique risks attended to it.
Let me second this. We see, the art dealer market is tiered. The biggest shift of a dealer going from the mid-market to one of the mega international dealers, I think, is mostly a mindset. They all have very good artists, they all have curatorial staff, they all have a good eye. For the most part, they're charming people. But at one point, a dealer, when they decide we're going to actually professionalize our practice, we're going to treat ourselves as an institution, we're going to treat ourselves not as a 19th century idea of a handshake and do the deal, but as a real business with an audit, with a CFO, with a capital structure that includes both equity and debt, and presents itself to a bank, to a commercial banker or private banker in that way. They're able to grow and as artists' estates, as new artists, they actually are attracted. The reason why David Zwirner and some of these others are attracting all these artists' estates is because they're run like an institution, and artists' estates and artists endowed foundations have their own requirements they need to meet when they have vendor relationships. So this is something dealers need to think about. When they get to a level, they need to think about professionalization, and that's kind of the key hill that we see a lot of the best dealers go over when they get to kind of be these mega dealers.
One thing that might help in that thought process is to have some respect for the lender's problems in making these loans. I think there's insufficient attention that's paid to that. One thing that became clear to me after representing banks it took me a while to get this, is that the weakness in their business is that they only know what the borrowers tell them. In the end, as a practical matter, that's the truth. And so the quality of the accounting and the quality of these kinds of business practices all matter a great deal. They have to have some respect for the reliability of the reporting that they're seeing. And that's something that I don't think a lot of people recognize. It's not even that easy to see, but it's the truth.
Yeah, no, I agree. And to your point, for a young dealer, a young gallerist that just opened on the Lower East Side, Chelsea, wherever, I think the best thing you could do early on is get an equity partner. Find some billionaire who is dying to be hip, that wants to have some cultural cachet, that wants to be in the game a little bit. You giggle, but these people are dying to be part of this milieu, and they will, take a 5% stake. And the dealers that have really been able to grow and leverage that, a lot of the Upper East Side dealers have magnificent equity partners behind the scenes, many of the billionaires around the world who just love the cocktail parties, love going in on, a potential discovery of a Baroque painting. And this is a really, really good strategy for a young dealer, young gallerist that's never going to qualify for a bank loan to grow. And then when you get to a certain level, you can start looking at the balance sheet and the capital structure. And having a partner like that actually can help in that maturation process as well.
I would just like to say that I am on record before Evan said that as having stated in the past that when it comes to seeking older investors who are chasing the cool, as I say, art galleries are the new nightclubs, they're the new restaurants, whatever. Like, this is where people go to try to actually be recognized as interesting. But let's follow that thread a little bit then, because obviously, and Anders, this is something that's covered in pretty great depth in the report, which is this friction of a lot of dealers sort of not wanting to give up a certain amount of control of their business. Part of the reason that they, I think that so many of them operate just off of their own earned profits, et cetera. Obviously, coming in and just immediately saying the first thing I want to do is go in with somebody else, and somebody else who may not even know the art world at all, it's a big step, and it's going to affect what you can do in most cases. In your conversations with the exhibitors at TEFAF, what kind of reactions did you get to that area when you brought it up?
Well, I think, first of all, this is also kind of wider research we've done around galleries and the motivations for galleries in general. I mean, they're not typical businesses. I think most of the people has either left a world which they felt was cold and maybe just money, and including myself, came from banking, ended up doing this, and there's virtually no money in it. So, and I think a lot of people are, and I'm driven a little bit by the same thing, and I do not like external parties. I do not want to have people involved. And I think so the dealer thing is there's an emotion passion business. Doesn't mean that all, I'm not saying overall, but I think there's a resistance to have anything external elements, whether it's on the equity side or the debt side, of having someone to sort of tell you that, you need to pay this, or the lack of understanding. I think a lot of the things with the debt side, when we talked to the dealers, was it was linked to the way they do their business and the lack of recognition from the other side that they're not going to have monthly equal cash flows coming in. They're going to have this maybe once a year, maybe every December, a massive lump comes in. And so I think there's a culture difference, but I think strongly that actually galleries at certain levels set up their business motivated by totally different things than just making profit.
It's so true. Look, if we were to get together, go in a white room, get a whiteboard, and design the absolute worst possible business model in the world, an art gallery would be it. I mean, expensive retail spaces in the most expensive centers in the world, Hong Kong, Chelsea, London, where you don't expect anyone to actually walk in there. Highly capital-intensive inventory that is very difficult to sell, and most people, you actually need to convince them that we won't sell it to you. A vendor relationship with antisocial artists who are famously difficult, and then this idea of getting a work of art and finding the needle in a haystack person that wants it on the other side and trying to do it while creating it's a really difficult business. So look, part of this is that this is not a business designed for, it's really run the same way as it was run in the late 19th century with Villard and Kahnweiler. And so we haven't actually seen a lot of transformation in this space. The motivation for folks in this space are completely different from the motivation of almost any other business. It's working with great works of art and artists and establishing a legacy and walking through museums where you've placed the art of our time, and you've become part of kind of the cultural patrimony of our time. And that creates a real challenge because, for us who want to kind of try and get them to think about this in cold, hard business way, it's not designed, and the motivation for doing it is not that way. So there is a bit of a disconnect there.
Yeah, and I think that this speaks to the valuation issue, I think, in a big way, because there's a lot of discussion about what do you call art in order to define how it gets valued. And if you talk to an economist, a good one, I would say that they'll tell you that it's something called a positional good, which what that means is that the value is determined entirely by its rarity and the prestige of owning that thing. So there are no external factors that really tell you much of anything about what this thing is worth. That asset, an asset like that, put into a world with financiers and due diligence and whatever else, it suddenly gets very strange very quickly. So one thing that I will mention, though, is that one of the other assets that is considered a positional good is real estate. So where are some of the disconnects between the types of things that you would see in real estate versus what you would see in art in terms of these types of tricky valuation and due diligence issues?
The biggest difference is that real estate, a lot of real estate actually produces a cash flow, and you could apply a cap rate to it, and you can come up with an idea of what it's worth. The cap rate, it reflects the perception of risk at the time. That's basically what it is, and they will move with different factors in the economy. But there is a way of ascribing some value to real estate when it's a cash flowing property. When it's not, if it's just a land loan, and those are looked at very differently by banks and other lenders, but then it gets much closer to art, because then you're. But there's one big difference, a crucial difference, which is that the reason that people buy real estate, investment in real estate, their motivation is what the bank would like it to be, because it's economic. And so they're thinking for the bank in a way that the bank can understand and make sense as collateral. The difference with art is the chasing the cool factor. It's exactly right. It's that it's never, even if it's an asset class and it has great values ascribed to it, it is never going to be a purely economic decision to own it. Almost never. So that's a crucial point.
It's an important point. You know, the biggest value driver of art is ultimately the influence that work of art has on the culture at large or other artists. And because of that, it's many times the concept or idea behind the art that actually bestows value on it and the motivation for folks who want to own it. So we just did an art loan against, and this was a real challenge you can imagine for a group of underwriters who were very financially driven. They had a Felix Gonzalez Torres, which you may know is a pile of candy that's meant to disappear over time as it's eaten. That was appraised for $6 million. One was an Yves Klein happening from the 1960s. It doesn't actually exist as a work of art, but there's a little certificate that trades on the market that's worth about a few $100,000, saying you own the essence of this Yves Klein happening. So that's appraised at a few $100,000. Try and convince an underwriter that a work of art that doesn't actually exist is worth a few $100,000. So from these works of art, we were able to unlock a couple $1 million, a pile of candy that's meant to disappear and a work of art that doesn't exist. So we're at least at the stage where philosophically we could actually lend against not works of art, but ideas and concepts. So look, we're at an advanced state. That's kind of interesting. But that's very different from a piece of real estate that's spinning off rent. So it's a completely different space.
I think the other thing is also regarding the valuation industry as a whole, and I know it's slightly different here in the US than compared to Europe, but the value as paying for valuation is not something which is sort of, it's almost a kind of auction houses are using it slightly as a business getting tools. You have something in the UK called Value My Stuff that gives a valuation for £18 or something, which is virtually, I don't know how you will sustain such a business model. And it's actually one of those most important things in the whole thing. If we don't trust that value, but there's no industry around it that can almost kind of commercialize the independence of valuation. So you had a problem also who values, and I think that is worldwide a potential issue.
Banks are, all lenders actually are certainly aware of the built-in potential conflicts when auction houses are used as appraisers. Now they have wonderful diligence platforms, and there's reasons to allow it, but it's not that lenders are not conscious of it in the U.S. They certainly are. And so you'll see some lenders liking to use firms like Winston or Gurjans or something like that for that reason.
Well, we're jumping ahead here a little bit, but I'm going to do it anyway. Obviously, one of the other issues that we get into in terms of due diligence and valuation, all that stuff, is authenticity. And one thing, to go back to the real estate comparison, that real estate has that artwork does not, is a title registry. Now, title registry is, for anybody in the audience who doesn't know, just essentially a document, a ledger that says who owns what asset and how it got from one place to another. And this is how you know when someone tries to sell you a house that they didn't rob someone on the street and have them tied up in the basement and they're trying to sell you the house that they don't actually own. this doesn't exist in art. And there is a push now, and Nana wrote a piece in the report about using blockchain technology to try to create a sort of uncorruptible digital ledger for artwork. I don't want to go too far down that path because it takes us into a whole other kind of headspace. But I do want to talk about this idea of a title registry a little bit. Like, how much, if there was such a registry out there, how much would that change the conversation for lenders when it came to sort of the costs and the risk and the uncertainty of lending against art?
From my point of view, it's a world of difference. And I actually am a big proponent. I've written about this. I don't want to spend too much time, as you say, because it's a whole other subject. But there is title insurance available for art. I would like to see it used a lot more, and I think it would ultimately benefit the entire market, because that is one of the big risks. And the kinds of things that people think about when they first look at title concerns with art are World War II claims and other kinds of restitution claims, or things illegally smuggled out of countries and cultural property and things like that. They worry about the bigger issues. The truth is there are a plethora of smaller things, much more mundane, everyday concerns that the best example being theft, just garden variety theft. I'm not talking about Hermann Goering going into Amsterdam. I'm talking about just a theft from a gallery in 1973 that led to a big lawsuit with Steven Spielberg over the Russian schoolroom painting 35 years later. And that kind of thing happens. And if you could eliminate those concerns or substantially mitigate the risk through title insurance or some kind of a registry, you would have a very different quality as collateral.
Yeah, and briefly, I know we're at our time, and I want to make sure there's questions, but one of our clients bought Franz Hals, $10 million at one of the auction houses. We go out, we have a great celebration in his living room. I remember even the curator of the Louvre sort of melting in front of it, saying this is one of the great Franz Hals. I mean, you could see the early impressionistic strokes in there. We get back in New York Times headline, this was painted in a garage in Queens a few months ago by a Chinese immigrant. It's not a real Franz Hals. He was refunded his money, etc. But yes, I think it would be very interesting to have one of these databases. There are challenges. There are Titians that become Tintorettos and Tintorettos that go back to being Titians that hang in galleries. And this is a space of the market where sometimes opinions matter more than facts. And my opinion doesn't matter. It's the opinion of a few highly regarded academics who have their specialty. So, look, I'm all for this. I think it will help us. It'll create confidence, particularly in the contemporary space, if there is some ledger around this. I think we're in the very early stages. It's can we get a first mover to kind of really come on and get some of the top galleries doing this?
Right. So how are we doing on time? I should ask that question before I keep going.
I think we're
here.
at our time.
Audience questions? Okay. All right. So I think that's our cue to shift into audience questions. So if anybody out there has anything, Magnus?
Anders, I love your work. When I wrote my bachelor thesis, I was already referring to your work, so I'm a great admirer.
Thank you.
Why did you write this report? I mean, let's look at this. So the sample size is incredibly small, 140 galleries. It's not representative of the art gallery world. And those galleries that we look at are at the very top end.
Yeah.
In terms of turnover and so on. Secondly, even those galleries, when we asked them, hey, do you want to be financed? They said, no, we don't want it. That's not because what you said, owners of artworks can loan against it. But galleries, we all know they work on commission, on consignment, so I have nothing to loan against. So, and for them, it's a hassle dealing with all of this. And then thirdly, are there more relevant issues? TEFAF has a history of producing the great TEFAF art market report, outstanding, that everyone needed in the industry so much. Why don't we focus on such a niche topic that people don't really want and need?
Well, I mean, I guess there's many.
That's what's great about Magnus, you
Yeah.
know. Hey, come on.
I think there's many things here. I mean, first of all, why we do it? We tend to explore lots of niche areas. We much more interested in the niche than the big picture, because I think the TEFAF report in its past, Art Basel reports right now, I think covers something great, but it lacks in many, and has nothing to do with the report, but I think it needs depth. There are probably thousands of fields like this that needs to be explored, and I think it's not about the sample size, and as you say, you're absolutely right, this does not, and clearly also when we flag up what this sample is about, it covers a very specific segment of the market. It's relevant only to that segment, but obviously if the problems exist in this segment, which is a very specific part of the market, then that's endemic to virtually the entire industry as a whole. So we, in a sense, it was not a decision not to do. We explore. As I said, there's hundreds of the themes out there. I know, and also I just agree, just in terms of it needs more research. I mean, I don't think it's a substitute, but maybe TEFAF obviously commissioned me to do this.
May add one thing, Magnus, I love you dearly as well, as you know. What we try to do is to cater to our dealer community. And as I just said in my introduction, what's important to us as an umbrella organization is first of all to think, what do you do as an umbrella organization apart from facilitating the space and making sure that's their security? So this is one of the ways how we try to inform our dealer community, and we just saw that hardly any dealer actually knows exactly what people like you're doing to inform them about it. And this time it's about the financial side of the art market. And in TEFAF Maastricht we spoke about all the legal aspects that are coming our way from litigation. So it's primarily to cater to our dealer community, I would say.
Yes, sir.
Yes. I have actually 3 questions.
In prioritized order.
Well, not in prioritized. From a simple to more complicated. The simple question: what is the value of all art loans out there, which is purely art loans, which basically means it's not collateralized by my Google stock or Carlyle's and Blackstone's of the world. So that's sort of the first question.
I estimate it to be a very thin slice of the market, maybe $1 billion outstanding out of the 20 billion, maybe more, 2 billion.
It's more than that, yeah.
2 to 3.
So
Yeah.
what you're saying is that there are a few $1 billion outstanding loans just against art.
Yeah. Purely collateralized.
Purely collateralized against that. So it's like 3 million, 4 million? Or
Yeah. It's a growing segment. We have Athena in the room, Sotheby's, Borrow, and we're great champions of them. We need that space to exist.
The second question is, and this is maybe a little bit of jumping ahead of the game. Here is a scenario. In 1992, when I happened to just start to collect, overnight, literally, took one sale of Sotheby, and I wasn't the sale, I was like very greedy. And once a bad sale, and the market, it's a very fast-growing market, just overnight disappeared. The Japanese disappeared, the collectors sort of moved on the step lines. Now, the question here is, right now it's by far much more formed consumer, and there is a lot of providers out there of pure art.
Yeah.
Estates, artists, blue chip, non-blue chip, etc. Now, if you look at the market itself, and I deal with this, I'm a number guy, so I'm looking at it quite frequently. If you look at it, half of the market prices are published, it's an auction. Another half is purely transparent at this point because it's dealers. Now, let's assume 3 years from now, 92 happen again, like in real estate, 2008.
Sure.
How do you think the banks or providers of loans will behave
It'd be
if you don't have a report?
Yeah, for us, it's, our book, we evaluate art in the context of a very large balance sheet. So our art loan book's $6.5 billion in loans, art loans outstanding against billions and billions of hedge fund loans and yacht loans and aircraft loans. And so for us, it's less if the art market completely collapsed, and we actually expect a lot of contemporary art in our collateral pool to go very near to zero over the next 10 years as there's a winnowing out of what the art of our time is. We don't think it'll affect us all that much. The more risky element in what we're tracking is, are our art loans to hedge fund individuals if we have a big shock to the hedge fund world, or if we have a big real estate downturn, because 1 out of every 4 of our art loans are to real estate executives. So we tend to look at the source of wealth rather than the actual art when we do our, we look at both, but that's probably a bigger source of risk. If we were purely collateralized, like Athena and Sotheby's, a shock to the art market would have a more pronounced effect on us.
All right. Sir, before we complete the trifecta, I'm going to see, out of respect for the rest of the audience, if anyone else has any questions first. Yes?
I just have a comment to Anders regarding art loans in Europe. I know the situation in Germany, that there is no independent art appraising profession, whereas in the US we have a thriving, very professional group of independent art professionals, where galleries would not be afraid to have competitors like auction houses snoop into the inventory.
Yeah, no,
So here is a
and that's what I mentioned, the difference between Europe. I mean, not only Germany, but UK has the same, that there is no appraiser association or a standard set around it. I mean, there's RICS, I guess Mark might have sort of, there are, but it's then the recognition, I mean, anyone can value. There's, if they wanted to, whether it is trusted is another thing. I think that the framework you have here in the US, there's also lends itself better to the kind of market we're talking about here.
Yes, over there.
Thank you for this report. I think it's very interesting to look at dealer financing as a lens onto art as an asset class in general. Amy would agree. NYU. One of the things that comes up in class a lot is noticing real estate as a litmus test for the financial viability of running a gallery. The dealers who bought real estate are usually in a much better position, and I'm just wondering, especially given the expertise on the panel, if you could talk a little bit, and this speaks to the kind of more normative question you were raising earlier, Anders, could you speak a little bit to, in the context of whether it's good for dealers to take on more debt or not good, how real estate feeds into art? Because I'm wondering if there are real estate lending options with regard to this lumpy cash flow problem with gallery management that might be interesting relative to the real difficulties of kind of valuation of art in a cash flow sense.
The biggest problem is you're now piling one somewhat illiquid asset on top of another. So you're creating you're adding a real asset that has inherent value where you don't have to worry about the somewhat unique risks that I've been talking about with title and authenticity, certainly. But at the same time, there are commercial real estate, and I know this from long experience having represented banks both in originating these loans and in workouts, both in the early 90s and late 80s and a couple of other turns in the cycle, including the most recent one. There are times where it doesn't matter what you want, what price tag you put on the property. Nobody wants it. And so there's real risk inherent in that too. We do have I do represent one bank in New York where there is a substantial and very valuable, and it's gone up quite a bit, piece of real estate that is owned by the gallery, and the bank in question lends both against the inventory of the gallery and against the real estate, and it kind of mitigates the risk to that extent, and sort of the way Evan was describing in the private bank arena. This is a middle market loan of the type that I wrote about in my article. This is one of the dealers that has been able to get inventory financing, and underneath it all is the fact that they have some real estate. There's a mortgage loan, and the bank looks at the whole package and says this is a more acceptable picture to us.
Yes.
Yes, my question for Anders. I know that the blockchain is a future discussion, but if there is a secure set of data points in works of art, how is that then linked to the object so that it's clear that all the transactional data being preserved relates to a valid piece as opposed to a consolidated to still clean.
Well, there's probably other people here who have more expertise than me regarding it, but I think there's several issues. I think one is the issue of what goes onto the blockchain is of quality, because a blockchain in itself is a technology, but if what you put on there isn't vetted or hasn't, then obviously you just almost amplify the problem. The link between obviously the object and the blockchain, so the physical, there's different technologies out there now. So you have a UK company called TagSmart, which is tagging using something which is working with the Cambridge University to try to, different thing for different mediums. There are people looking at the pixelation and almost a kind of genetics of a painting. Again, all these things are, I think, is in its infancy. There's no standard yet, but that's obviously, again, one of the challenges is you got to have somehow, like a car, you have a VIN number or you have a security. They're linked to that object, or that specific security is linked to a specific number that can, so that's, Nano might have more where this is going. I don't think there's not, doesn't feel like it's a set field. There's a lot of technology being developed and evolved, and I think this is part of the process going forward. Maybe, I don't know if Tim has another thing, or
I don't see how this can work except for new works. It can't work for older works because you're starting out with a questionable assumption that goes in the first place. That's the whole problem. You can't, there's nothing you can do about that. It's just, in the United States, it's not even a legal issue because it's really what the market decides. There's a famous case, I forget the name of it, but a famous case that really set the standard for the way people look at this in the United States, where there was I believe it concerned a Calder sculptor. I may have that wrong, but the court, there were two experts that disagreed. This is about 10 years ago. Two experts that disagreed. The court went with one of the experts at trial and decided that the work was authentic. It had to do with a warranty of authenticity that was involved in the transaction. The trouble was that after hearing the testimony, the market went the other way and decided the work was not authentic, and it believed the other expert. And subsequent courts have commented, specifically said, it doesn't matter what we say, it matters what the market thinks. And that's the way it is in the United States. So you can't really even, you could write insurance, for example, on authenticity that would be tied to the outcome of a particular case, a particular judicial decision that would be made. But all that you could do would be to give the person back the money that they paid. You couldn't in any way ensure ultimately the market value because it's not a legal issue. You can do that with title, but you can't do that with authenticity. And you run into the same problem with blockchain or anything else except for new works. Then you conceivably could do it.
And I'll just add on to this because I've been doing a lot of research and writing about blockchain, both as it relates to the art world and kind of in other contexts. This is not something that's a problem exclusive to artwork. I spoke to a gentleman who runs, I don't know if anybody has heard of CryptoPunks, but they're a digital collectible, essentially, that is run on the blockchain that is now doing thousands of dollars of turnover every year, well, as long as it's existed anyway. And I was talking to him about these issues of connecting artworks to information on the blockchain. He uses terminology which I think is really interesting, which is the blockchain air gap, which is this idea that anytime you're taking digital information and trying to apply it to anything in the physical world, it's difficult to connect those two things. If you were trying to sell a house that had been tracked on the blockchain, if you showed up after you'd struck the deal and you'd paid the money and all those things, and the person who sold you the house had barricaded themselves in the house and decided they weren't going to actually let you move in, there is nothing that the blockchain would be able to do for you in that situation. So this is just something to keep in mind as you hear more and more talk about blockchain, both in the art world and more broadly. Anyone else before we wrap up here? My friend in the white shirt, would you like to go back to the third of your three questions?
I mean, the report that you provided, which in my opinion actually is helpful, I understand it's really a small slice of the market. But from 142 dealers that you discussed, because of TEFAF heritage, majority are Europe, I think you said.
Yeah.
How different do you really think the report would be? And I know many dealers that you probably survey are, the top 10 as well, but putting the Gagosians and the Swirlers of the world aside. How different do you think the report would be if it would be focused, for example, on the States, where the market a lot driven also by contemporary, I think it's much more skewed toward contemporary blue chip artists and things like this. How different do you think it would be?
So you mean basically go to something which is more contemporary than what?
If your sample was more US based versus Europe.
Yeah, no, okay. So, yeah. So I think again, it's a tier thing. I think if this was done, majority was US, I think already within the smaller sample of US dealers, you see there's a much more adoption or much more, using debt in a different way. And that's partly because this is 90% where the market is. So this is just availability of finances here. I think as you then move down the scale of top tier, mid tier, I think it starts to dry out quite quickly. So even if it's more available here, I think it's still a very sort of thin sliver of the market that actually has access to finance, which again, I think for the validity of a report like this, I think it addresses bigger issues, and I think it addresses, going forward, how do we accept that bigger galleries is going to be bigger and bigger? What kind of financing can be? I mean, Tim sort of talked maybe about consumer financing. I mean, can galleries help with cash flows? The problem, obviously, when you're starting to deal with consumer financing, like we do with car dealerships, is it's not accepted in the art world. It's almost kind of things. If a client, asks for consumer finance, like but actually someone else takes on that risk, it kind of interferes with the client relationship. It sends the wrong signals to the market. So instead, what do galleries do? Well, they give out 12 months free installments, but at no interest. So I mean, I think there's certain things in the art world which I think over time needs to change. It's about the survival of the gallery model as it is. I think it needs to professionalize. I need to think, even if I said there are passionate people involved in this thing, doesn't mean that you can be savvy on the business side. And I think it has to move that way for sustainability purposes. We see how difficult these galleries have now in terms of sustainability. Reports are showing declining galleries, the pressure on art fairs. All of these things are real, and I think finance could potentially play a role here, also further down the food chain.
Thank you all.